You just got a $12,100 bonus. Do you invest all of it today or spread it out over the next 10 years? Most people assume spreading it out is safer. The data says otherwise. This is dollar cost averaging versus lump sum investing, and it's one of the most misunderstood decisions in personal finance. Dollar cost averaging means investing a fixed amount on a regular schedule, say $100 a month, no matter what the market is doing. Lump sum investing means putting all your money in on day one and letting it ride. Let's use real numbers. I pulled 10 years of S&P 500 price history from August 2016 through August 2026 using SPY as the benchmark. Over that stretch, SPY climbed from $217.38 a share to $765.72 a share. Here's the test. Investor A puts $100 a month into SPY for 121 months, $12,100 total, dollar cost averaged. Investor B takes that same $12,100 and puts all of it in on day one. Investor A's dollar cost averaged portfolio grows to $25,487. That's a return of about 111%. Investor B's lump sum grows to $42,622. That's a return of about 252%. The lump sum ends up worth over $17,000 more. Same total investment, wildly different outcome. Why the gap? Because markets rise more often than they fall. Every dollar invested later instead of on day one misses out on the returns those earlier dollars were already earning. Vanguard has studied this exact question going back to 1926 across the US, UK, and Australian markets. Lump sum investing beat dollar cost averaging in roughly 2/3 of all rolling periods they tested, typically by 1 to 2.5 percentage points a year. So, should you always go all in? Not necessarily. That 2/3 number means lump sum lost about 1 time in 3, usually when a downturn hit right after the money went in. Dollar cost averaging is not a return maximizing strategy. It's a volatility management strategy. It smooths out the ride and it protects you from the psychological gut punch of dumping your savings in right before a crash. If you're investing a windfall you already have sitting in cash, the math favors deploying it sooner rather than later. If you're investing out of your paycheck as it arrives, you're already dollar cost averaging by default, and that's completely fine. This is general information, not personalized financial advice. Past performance doesn't guarantee future returns, and every investor's timeline and risk tolerance is different. If this helped you think about investing differently, subscribe for more videos that turn real market data into decisions you can actually use.